My name is Brian Johnson, and I am a former institutional investment manager with over 30 years of experience in the financial markets. I am now a full-time derivatives trader. This is the second in a series of videos that will demonstrate the use of the option strategy hedging and risk management spreadsheet that accompanies my recent in-depth article of the same name. The 120-page article, which is closer to a short book, represents a comprehensive analytical framework and accompanying spreadsheet tools for managing and hedging option strategy risk. Specifically, the framework can be used to hedge option strategy exits and adjustments. In addition, the framework can be used to identify the most cost-effective black swan hedge solutions using actual VIX call options and actual put options on the underlying security. These practical new hedging tools can be applied to any option strategy in any market environment and should be used with all option income strategies. The purpose of this video is to demonstrate the second component of the option strategy hedging and risk management spreadsheet, which is futures hedging. Before we can review the futures hedge tab, I need to explain how and why futures will be used to hedge option strategies. As I explained in the last video on position sizing, the position sizing formulas are only valid if our actual loss on each trade is less than or equal to our planned loss on each trade. Unfortunately, overnight gaps and discrete and unpredictable black swan events invalidate that premise, which can cause unhedged option traders to lose multiples of their maximum expected losses. Futures hedging cannot reduce all discrete event risk, but it can greatly reduce the risk of unacceptable losses, and it is virtually free. I will use equity index futures, specifically the E-mini S&P 500 index futures, or ES contract, in this example to hedge the exit risk of an iron condor strategy on the S&P 500 index, or the SPX index. Again, I explain these hedging techniques in much more detail in the article. Equity index futures have several hedging advantages. The ES contract is one of the most liquid contracts in the world with exceptionally low slippage and transaction cost, even during periods of extraordinary volatility. In addition, the ES contract trades almost 23 hours per day, which greatly increases the likelihood the hedge transaction will be executed at the desired market level. We will use futures to immediately hedge the market or delta risk of an option strategy at the desired or target exit level. In this example, I assume our target exit level is a 20% loss on the iron condor strategy, expressed as a percentage of Reg T capital. Figure 3.1 is an option view exhibit from the article that depicts the change in value of the iron condor, as shown on the vertical axis, as a function of the price of the SPX, which is shown on the horizontal axis. The required capital for this strategy was roughly $107,000, which means the 20% loss would equate to approximately $21,000, which is represented by the thick black horizontal line in the figure. The thick horizontal line intersects the bottom T+0 line at a price of 2257.9 on SPX, which is the initial exit target level as modeled by the option view software. However, we cannot guarantee that the option market would be open when the SPX price level was penetrated, so we place a stop limit order to sell the ES futures contract when the price reaches 2257.90. The only question is, how many contracts would we need to sell at that point? The Futures Hedge tab can answer that question, but we need one piece of information from the option view software first, or from a similar analytical platform. We need to know the position delta of the iron condor strategy at the exit trigger price. The typeface in the diagram is small, but the expected or modeled position delta of the iron condor at the exit trigger price of 2257.90 would be a positive 372.3. We see that number 372.3 directly across the delta row underneath the column directly under the price of 2257.90. So in other words, if the price of the SPX hit 2257.90, the option view software indicates at the time the position delta of this specific iron condor strategy would be a positive 372.3 at that price level. Why would the position delta be positive? Why wouldn't it be negative? The reason it's positive is because the iron condors have negative gamma, which means their value falls at an increasing rate as SPX prices decline. As a result, they become overexposed to the market when prices decline. We can use futures to immediately hedge the market or delta risk of the option strategy, and we maintain that hedge until we can exit the option strategy at a reasonable price level during normal market hours. We are now ready to use the Futures Hedge tab to solve for the specific futures hedge transaction. There are 5 tabs in the spreadsheet: Terms, Holidays, Position Size, Futures Hedge, and Equity Put Hedge. All are located along the bottom of the spreadsheet. This video will deal exclusively with the Terms and Futures Hedge tabs. The first step is always to read and accept the terms and conditions and affirm that you have purchased the article. This is accomplished using the drop-down boxes on the Terms tab of the spreadsheet. The same disclaimer that you see in the spreadsheet applies to this video as well. All videos in this series only provide a simple demonstration of how to use the spreadsheet tools that accompany the article. The article itself includes a comprehensive discussion of the framework and methodology used in the spreadsheet, including several of the formulas. Now let's move to the Futures tab. Cells with blue backgrounds represent user input cells. All other cells are calculated by the spreadsheet itself. So the blue tabs are listed here, the blue backgrounds are listed there and outlined, and then the calculation tabs appear immediately underneath those values. The first thing you'll notice in the spreadsheet is that several of the cells contain the word value with an exclamation point. These are not actually errors in the spreadsheet. Every single function and macro in the spreadsheet requires the user to accept the terms prior to doing the calculations. As a result, sometimes when opening the spreadsheet or before accepting the terms, these values are not actually valid. To eliminate that from the cell, go up to one of the user input cells that will actually force the recalculation and enter a different number. Immediately upon doing so, it will recalculate the calculation cells and get rid of that word value in the calculation cells themselves. All right, so let's start with the inputs. At the top of the page, in cells B4, the first input is 372.3, which represents the position delta at the desired exit level. This is the level that indicates that we are long in a down market, so we will need to hedge that using the futures contract. The 372.3 represents the value that we found earlier on the option value spreadsheet. The next cell, immediately below this, is B5. That simply indicates that we are using an index as the underlying security type. That has nothing to do with the calculations. It's strictly used to make it easier for the user to understand the inputs for this particular spreadsheet. The next cell, B6, represents the current underlying index price, in this case the SPX price, at the time the trade was entered. So 2,366.40 was the price of the SPX index. This value is used in the actual hedging calculation in order to figure out the number of ES or E-mini S&P 500 contracts to purchase or sell to implement the hedge. In addition to knowing the underlying security or underlying index price, we also need to know the price at the exact same time of the hedging vehicle. In this particular case, the hedging vehicle is the E-mini S&P 500 index. At the time that trade was entered, the price of the E-mini S&P 500 index was 2,365. So you see these values here. At the time the trade was entered, the underlying index at a price of 2,366.40, and the price of the E-mini S&P 500 index was 2,365. These relative prices are again important and are used directly in the hedging calculation. The next value, the next input value for the user, is the number 50, which is the futures multiplier for the E-mini S&P 500 futures contract, which essentially represents, in a way, 50 shares of the E-mini S&P 500 contract, meaning each contract purchased or sold is the equivalent of buying or selling 50 of the SPX, or 50 of the E-mini S&P 500, the price of the E-mini S&P 500. In this case, that value of 50 or 50 is entered in cell B8. And then finally, once we've actually entered all of those values, we can see that the spreadsheet automatically calculates the number of contracts to purchase or sell in the E-mini S&P 500 contract. In this example, with an initial position delta of the iron condor at the exit price, the position delta was 372.3, which would require us to sell a total of 7 E-mini S&P 500 contracts. Since we can only buy or sell an integer number of contracts, in this case selling 7, we would continue to have a position delta of positive 22.5 after the hedge transaction of the sale of 7 E-mini S&P 500 contracts. The hedge calculation indicates that we should enter a stop-loss order to sell 7 ES futures contracts when the price reaches the exit trigger price of 2257.90, which is the value that we found at the 20% loss level in the option view software. Since discrete black swan events are unpredictable, this contingent futures order should be entered immediately upon entering the position, but it may never be triggered. If the hedge order is executed, the hedge should remain in place until immediately after the option strategy position is exited, which it should be and then closed as well. So in other words, after the option position is exited, the futures hedge, should be closed immediately thereafter. As you can see, the futures hedge tab is very easy to use. However, a much more detailed explanation is provided in the article. Finally, let's review the resources that you might find useful in your trading and research. My first 3 option books are listed at the top of the resources page. Specifically, they're called Option Strategy Risk-Return Ratios, Exploiting Earnings Volatility, and Option Income Strategy Trade Filters. If you are interested in learning more about these publications, you will find Amazon links for each book in the right sidebar of the Trader Edge website. All books are available in print and ebook formats on Amazon. On TraderEdge.net, you will also find blog posts and links to discount offers from affiliates, all of which I use in my proprietary trading. Finally, Trader Edge also offers a monthly subscription to the OIS Universal Filter, which is a proprietary algorithm that is used to objectively rank entry and exit environments for option income strategy or OIS trades. This filter is discussed extensively in my recent publication, Option Income Strategy Trade Filters. I hope you found this demonstration helpful. If you have any questions, you can contact me via email at bjohnson@traderedge.net. Thank you.